Welcome to vTalkInsight Allocator's Lens Daily for February 26th, 2026. Cross-asset signals are flashing an unusual mix today. Equities are grinding higher on AI and capex optimism, while credit and options markets quietly price in fatter tail risks and geopolitics keeps oil and gold in focus. Let's start with equities, where the real story is not the index level, but how violently leadership is rotating beneath the surface. In equities, the headline remains a cautiously constructive grind higher, but with far more turbulence underneath than the calm indices imply. Global stocks are expected to stay volatile yet broadly supported over the next year, helped by ongoing fiscal stimulus, still accommodative policy, and a powerful capital expenditure cycle led by AI infrastructure. Pullbacks are seen as likely to be met with buying interest, yet the gap between index volatility and single stock swings is at multi-decade extremes, reminding allocators that apparent stability at the benchmark level can mask a fragile microstructure. One of the clearest shifts is relative, not absolute performance. A multi-year phase of United States equity underperformance versus the rest of the world is expected to continue, reversing more than a decade of United States dominance and pushing allocators to re-examine regional balance. Asia, particularly Hong Kong and Korea, and parts of Latin America, such as Brazil, are seen as increasingly attractive thanks to healthier macro backdrops and commodity demand, while United States equities screen expensive on most measures. In Europe, strong results and upgraded guidance from HSBC have lifted sentiment toward banks, even as consumer-facing names tied to weaker guidance and dividend cuts signal more persistent pressure on stretched household budgets. Within United States markets, leadership is still highly dependent on a narrow group of mega-cap tech names, with NVIDIA at the center. NVIDIA is seen as having exceptional earnings momentum, underpinned by hyperscalers doubling expected capital expenditure growth to around 60% and a reported revenue pipeline that far exceeds current forecasts. The company maintains a sizable technological lead in AI compute, and the broader semiconductor hardware cycle, including optical interconnects, is described as still in its early innings. Yet expectations are now so elevated that even a strong beat and raise might not guarantee sustained price gains, and investor surveys increasingly flag an AI bubble as their top risk, underscoring how much sentiment hinges on a handful of prints. AI-driven disruption is already reshaping the software complex, where multiples have compressed from around 10 times revenue toward 3 to 4 times in many cases, and some names now trade back at or below pre-pandemic levels. Despite a roughly 30% drawdown in parts of the group, valuations in aggregate remain above long-run averages, implying that investors are demanding either sustained earnings resilience or further derating before leaning back in with size. Recent results illustrate that dispersion. Salesforce delivered better than expected revenue and profits and expanded its buyback program, but the stock remains under heavy pressure this year, while Snowflake enjoyed a modest post-earnings bounce on slightly better guidance and demand for its data platform. At the same time, idiosyncratic moves like a double-digit surge in Axon or sharp declines in HP and Workday show how investor focus has shifted from broad AI beta trades to very stock-specific assessments of disruption risk. Beneath all this, positioning and hedging activity underline the sense of fragility. Hedge fund turnover has jumped to its highest level since 2021, with gross exposures near records, pointing to aggressive rotation rather than to risking, while options data show elevated demand for downside protection and above-average hedging costs. There is also a notable shift towards sectors that either benefit from AI infrastructure spending or offer more tangible cash flows, such as industrials, materials, utilities, and middle-income consumer segments that are enjoying a tailwind from larger tax refunds. Looking ahead, earnings from NVIDIA and other AI bellwethers, together with any escalation in tariff policy or geopolitical risk, are likely to determine whether the market can sustain this broadening leadership or snaps back to an even narrower, more fragile dependence on a few names. Turning to rates, the dominant theme is policy stasis and fading volatility. Major central banks, including the Federal Reserve and the European Central Bank, are widely expected to keep policy rates unchanged this year, which is helping to anchor curves and suppress day-to-day swings in yields. In the United States, Treasury yields are seen as broadly range-bound, with the Fed signaling that cuts are unlikely in the near term and will only come if the data deteriorate meaningfully a stance that is less dovish than current market pricing for easing. At the same time, Treasuries continue to act as a safe haven during risk-off episodes, even as structural forces, such as fiscal pressures and questions around long-end demand argue for a higher-for-longer yield environment overall. Investor preference within that framework leans towards short and intermediate maturities, where income is attractive and duration risk is more manageable, while caution persists around the long end of the curve. Japanese yields have crept higher and narrowed differentials with the rest of the world, encouraging some global investors to reassess heavy United States duration positions, and European rates have stabilized, reducing rate-driven volatility for insurers and other liability-sensitive buyers. Interestingly, bond yields sit near year-to-date lows, even as equities trade positively, signaling a degree of skepticism in fixed income about the strength and durability of the growth story that is currently supporting risk assets. For multi-asset allocators, the key watch points are incoming inflation and labor data, any change in Fed rhetoric around the pace and timing of cuts, and signs that foreign demand for long-duration treasuries may be shifting as relative yields converge. Credit markets present a split screen. In public markets, spreads remain extremely tight across both investment grade and high yield, leaving limited room for further compression and raising the bar for generating returns beyond simple carry. This benign pricing sits uncomfortably alongside default rates in speculative grade credit that are running around 6% and have stayed elevated for 2 years, suggesting underlying fragility is not fully reflected in spreads. On top of that, tech and AI-related capital expenditure is being financed by a wave of bond issuance that already exceeds $700 billion for the sector, with expectations of up to $150 billion more tied specifically to data center build-outs, increasing the risk of supply indigestion and spread widening if investor appetite softens. The picture is far more challenging in private credit. UBS strategists have lifted their worst-case default rate assumptions for private credit from 13 to 15%, well above historical norms, citing AI-driven disruption and the heavy software exposure buildup during the era of easy money. Recent asset sales at discounts, fund closures, and rising redemption requests, particularly in vehicles marketed as semi-liquid, have drawn comparisons with pre-crisis stress, while business development companies now trade at discounts and offer double-digit yields, signaling a meaningful liquidity premium. Concerns are especially acute in asset-light software and AI-related borrowers, where recovery values are naturally lower, amplifying the potential impact of any default cycle. There are, however, important stabilizers that differentiate today from past credit downturns. Large private credit platforms continue to attract sizable fundraising, and the secondary market for private credit is emerging as a distinct asset class, with activity driven more by institutional portfolio rebalancing from pensions and insurers than by foresellers. Many software-focused private credit structures also benefit from substantial equity cushions, often at 20 to 40% loan-to-value, providing some protection even after sharp equity repricing, and the institutionalization of leveraged loans and CLOs has increased overall system resilience. For allocators, the tension to monitor is between very tight spreads in public markets that leave little margin for error and growing evidence of stress and liquidity risk in private channels, especially where AI disruption and heavy capex intersect with leverage balance sheets. In foreign exchange, the broad United States dollar has started to soften, particularly against emerging market currencies. European investors are increasingly de-risking and diversifying away from concentrated United States exposure, while Asian investors remain more committed for now, producing a gradual rather than abrupt shift in global capital flows. This weaker dollar backdrop supports the more constructive tone around emerging market debt and equities, where improving growth dynamics and relatively high yields can look more appealing once currency headwinds ease. That said, the depth and liquidity of United States markets mean any de-dollarization trend is likely to unfold over several years rather than quarters. Policy divergence remains a key driver for the yen and Japan. The Bank of Japan continues to favor dovish, reflationary leadership and low real rates, which has kept the yen weak and recently helped propel Japanese equities, as shown by the strong move in the Nikkei on days when the currency softens. Low domestic yields and a central bank that is in no hurry to normalize materially suggest only limited scope for a sharp, sustained yen rally, reinforcing the appeal of Japanese risk assets for global investors looking beyond the United States. For multi-asset portfolios, the main FX questions are whether this period of dollar softness can persist alongside elevated geopolitical risk, and how any shift in tariff policy or central bank guidance might alter the balance between United States assets and the rest of the world. Commodities round out the picture, with geopolitics playing an outsized role. Oil prices have edged higher amid renewed tension around Iran's nuclear program and more confrontational rhetoric from the United States administration, keeping a risk premium embedded in crude despite broader debates about future supply and demand. Options markets show investors heavily hedged for adverse developments, with positioning in oil and downside protection in tech-linked products at levels reminiscent of prior stress episodes, underscoring how closely energy and growth-sensitive sectors are now tied to the Middle East tape. Any escalation or de-escalation on the geopolitical front, including on tariffs and trade disputes, is therefore likely to reverberate quickly through both the oil market and related equity sectors. Gold continues to perform its dual role as both hedge and structural allocation. Stronger than expected returns have been driven not only by tactical hedging, but also by ongoing central bank diversification, persistent concerns about inflation, and elevated geopolitical uncertainty, all of which support continued institutional interest in the metal. Looking further out, the energy transition and AI expansion point to a long runway of investment in power and grid infrastructure, particularly in Europe, where electricity demand is now forecast to grow by 2 to 3% annually, and utilities like E.ON are lifting planned capital expenditure to ease grid bottlenecks. In the United States, policy moves that enable large tech firms to build their own power plants for energy-hungry data centers further link the commodity and infrastructure story to the same AI capex theme that dominates equities and credit. Stepping back, the cross-asset message is one of cautious optimism layered over accumulating tail risks. Equities still lean higher, but leadership is rotating away from a pure United States mega-cap story toward more international, cyclical, and cash-generative sectors, even as AI expectations and tariff uncertainty keep stock-level volatility elevated. Rates markets, pinned by central banks on hold, are signaling doubt about the strength of the growth narrative that equities are pricing, while credit shows public spreads priced for perfection alongside mounting stress in private channels and high yield. A softer dollar and a structurally weak yen are nudging capital toward emerging markets in Japan, and commodities are shaped by the interaction of geopolitical risk premia in oil and gold with a multi-year build-out of power infrastructure to support electrification and AI. For allocators, the key is to watch how AI-related capex, trade policy, and private credit defaults evolve across these asset classes, because they will likely determine whether today's quiet surface gives way to a broader repricing or a more durable broadening of the cycle. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.